we have just arrived at the next gold price inflection point, which will further serve to overwhelm mispriced Western gold and silver fix reference points.
They now have to keep printing or we crash.
We've got this ticking time bomb.
Talking gold with the one and only Andrew Maguire.
Welcome to Live from the Vault.
Welcome to Live from the Vault, brought to you by Kinesis Money. Now, Live from the Vault is the show that goes beyond the headlines to uncover the truth about the precious metals industry. And joining us today is Kinesis' very own world-renowned whistleblower and precious metals industry expert, Andrew Maguire. And this week, we'll be answering, of course, the many, many questions from our Live from the Vault community. And by the way, keep those questions coming in. And all you got to do to get your question is just look at the link below, and in the description down there, you'll see it. And you never know, your question may just be well chosen, and Andrew will answer it right here live on Live from the Vault. So let's head over to the UK right now and talking gold with Andrew Maguire. All right, Andrew, this year it's actually flown by, and it's hard to believe that we're recording our last market update episode of 2025. And as you predicted right from the very beginning, it's been a game-changing year on all fronts here. Net of the pullbacks that we saw here in gold. Gold has risen by over 60%, and silver, thank you very much, is well up over 100%. So we're gonna have a great Christmas for the silver stackers. And you're opening. Let's go back to even in January, our very first episode. You called for plus 1,800 higher end of year gold forecast of about $4,500, and it looks like that's magnetic. And you're also looking right on track for the silver at $30 higher. That was your target. And so to answer a lot of, and actually most of the subscriber questions, can you tell us what you expect in gold and silver when we open up trading again in our first episode? Let's go forward here. First episode of 2026. What are you seeing?
Great to be with you, Shane. Great to be with everyone. Where did it go, Shane? Where did it go? I can't believe it. This is it's almost like we just did our first episode last week. I mean, look, what we'll do is there's so much to go through here, and it's some good stuff here. Let's take a look at the end of year action first, and then really the drivers which will energize a 2026 $8,000 gold price and a minimum 140 silver price, which from a structural perspective, both should be hit. They should hit these next staging points. They're not even caps. These are staging points for the next rally. And this is what we can see right now. We can already see that they're going to be achieved before the end of the first quarter of 2026. And there's a myriad of reasons for these targets to be hit. So look, to put things into perspective, let's quickly reference the spot gold daily charts. Just for reference, we're recording this on Wednesday the 10th at between the AM and the PM fix, just after the market open. This is ahead of FOMC later, so obviously we're going to expect some volatility around this. But what we're looking at here is, let's put everything into perspective in the larger picture. Now, following the $650 rally from Beijing's opening of the Shanghai Futures Exchange on the 1st of March 2024 to the close of business on the 31st of December 2024, our projected 2025 targets were in sync with our Asian-facing liquidity providers, estimating that Beijing's progressive rollout of the Western-targeted SGE gold and silver corridor that would by year-end have seriously begun to arbitrage the differences between really the historically mispriced Western gold and silver pricing footprints versus where real physical supply demand structural supports were expected to lay. And as we've updated really every 2 weeks along the way, during the 12 months of 2025, that is, we've reached the absolute inflection point where Western CME LBMA liquidity has permanently fractured, enabling us to better assess our 2026 expectations. And as we looked at in more detail last time, physical market liquidity has broken free of the West's, as we said, we call it a toxic gold price ring fence that really it's no longer relevant because the BRICS-centric SGE and SGEI physically settled trading hubs is where the action is. It's where a competing real supply-demand price is being fixed twice a day. This real price, feeds back into the rapidly expanding Western-facing Shanghai gold corridor, where Western paper to global physical differences are systematically being arbitraged by central banks, sovereigns, and, I have to say, very, very large institutional buyers. And this is what has caused such an extended period of backwardations. You know what the backwardations were? Simply, you had a futures price that was well below the real spot price. All the way through 2025, we've been referencing them, and they really exponentially got worse as we moved towards the end of the year. Because it's where the COMEX legacy futures market prices have simply been underpricing the real price, and they're being targeted for physical delivery. Hence, the draining of this COMEX open interest, the gold warrants, they're not the gold warrants that are not real physical. Now, Beijing has stealthily moved to take control of the gold and silver markets, and they've now expanded into what really is, and it's under the radar for many people, into a full suite, high quality liquid asset, Western facing gold trading and storage corridor, perfectly suited to accommodating the very large move by central bank sovereigns and, most underestimated of all this year, the commencement of a very large move by global investment funds who are just in the very early stages of gaining exposure to a 40-20-20% allocation to gold. Now, in many cases, this is from a 0% allocation. And that places $8,000 gold as a floor by the end of the first quarter 2026 on its own. But it's not even factored into this new year expectation that something that we drew attention to just quietly in our last episode, which is the by stealth reemergence of the BRICS-facing payment channels. Now, in our last episode, based on feedback from a well-connected first-tier liquidity provider, we'd mentioned that the Bank of International Settlements sanctioned BRICS Plus gold-backed Bridge currency called the unit had secretly been retrialed into a second test trade, and this was done in November, following a 2-year trading halt. And this ghost trade followed the first test trade with the UAE back in 2023, which, if you recall, had been slammed shut after the Biden administration Russian sanctions forced the Bank of International Settlements to reluctantly back off the project. Things happen in a bigger time frame. So, yes, we had a pause. Now, we've been tracking the ebbs and flows and of the unit's progress ever since. And it's been mostly by tracking the BRICS meetings and the conversations around them, where there's been it's been deliberately underplayed for good reason, because there have been some threats against the BRICS by Trump. Now, progress to rekindle the BRICS Plus currency tariff, they stepped up significantly, though, after Trump threatened the BRICS nations, if you remember, with 1,000% tariff. Okay, it was posturing, but you can't put that back in the bag. And now with Russia and India utilizing China's linchpin physical anchor, the first leg of a rebranded, and it's the first of two proposed versions of Glasnev's gold-backed currency, is relaunching by stealth in the new year. Now, we did a lot of work on this, and if you recall, we looked at the two versions. Version one was 60% native BRICS currencies backed by 40% gold, and the second version was a 40% gold currency backed with commodities. Now, version one now mirrors the current unit structure that's just being relaunched, but we have plausible information that a 100% Russian-centric commodity-based version is likely going to roll out by the second quarter of 2026. And this is coming out in stages, and that's with or without Western sanction relief. And there's reasons for that. No one is better placed than commodity-rich Russia to roll out Glasnev's gold-backed commodity currency. And yes, silver is a participation commodity too. And the clues, they're all there. Russian gold and silver export controls are being ever more strictly enforced. Now, this unassuming official UAE test trade that we linked last time has secretly preceded this ECB official announcement on November the 20th that they'd interlinked non-SWIFT payment systems with India. Reuters picked this up on the 21st. This was the first clue that the BIS was once again getting involved with a BRICS-facing non-SWIFT alternative M-Bridge payment platform. However, we'd also received reliable information that the pre-trialed, institutionally geared Bank of International Settlements sanctioned M-Bridge BRICS gold-backed unit institutional focus benchmark token was also ghost tested with a sovereign which we understand to be the UAE. Now, liquidity provider feedback suggests the UAE test precedes an official rebranded launch of Glasnev's version 1, which is the 60/40 gold-backed currency, and Glasnev is 100% steering these relaunches. Then this was announced. While rebranded, this newly rolled out payment solution strictly follows Glasnev's original formula. Namely, the intrinsic value of each unit represents 1 gram of gold, while the just announced official launch initially incorporates just the first 5 BRICS nation currencies, and that's Brazil, that's Chinese currency, the Indian currency, the ruble, the ZAR, just those 5. But we've got credible information that Saudi, the UAE, and some 40 African currencies are also in the process of being ghost tested. The IMF estimates global South emerging and developing economies has a combined GDP, and this is IMF estimate, a combined GDP of $48.6 trillion. This is very attractive prize to go after. And just to put things into perspective, backing just 1% of global South GDP with gold, really with gold grams, would require more gold than is currently mined annually. Now, we've previously looked in detail at the structure of this previously trialed BRICS currency, which due to sanction pressures was shelved until one of two things could happen. Either a Ukraine peace deal could be negotiated, unwinding Russian sanctions, and or a sufficiently liquid, stable, physically derived global-facing gold pricing and storage corridor could be established. Both are in play as we move in 2026. None of this is factored into 2026 price estimates. The SGE-backed gold corridor has most definitely been established. We've been talking about it as it's been rolling out and the progression it's been making. and it's rapidly expanding westwards. Ironically, this is important, with the ruble now minted as one of the 5 participating unit currencies, and the bulk of the trade global south facing, it also is serving to bypass Western sanctions, by necessity accelerating a Ukraine peace deal. Now, the initiative will serve to neuter the EU's efforts to continue to so-called invest in a proxy losing forever war, which is most likely why the US is currently front-running negotiations with Russia for a post-war critical minerals deal. Notably, given the single Russia-phobic narrative, the mainstream media silence is absolutely deafening. Now, it's no coincidence that Russia is locking down exports of gold bars ahead of sanctions being lifted. Russian gold already feeds into the SGE and the SGEI, international facing high quality liquid asset gold corridor, enabling sanction-free Russian gold to provide trade finance liquidity without transferring title into a rising gold price. Simply borrow against it. President Xi has all along, I talk about a rising gold price, President Xi has all along assured his citizens on a regular basis since 2010, invest in gold, but it will appreciate solely on a rising price. Why? Because they understand the supply-demand, the imbalance, which is going to force as the West unloads this 50 years of price suppression and finally gets on board, which every bullion bank is already on board with. It's only the Fed that is still fighting this. Bank of International Settlements is also on board. So really, sanctions aside, really, altogether, Russia and China have been playing this long game since 2010. Unlike the West, who have leased gold into a rising gold price, which they can no longer control, Russia and China have employed high-quality liquid asset gold into a structured rising gold price without selling a single ounce. We'll look at this in more detail in the new year, which is just 3 weeks away, guys. I cannot believe it, 3 weeks away. However, with a viable version of Glasnev's gold-backed currency now reactivated by stealth on the 31st of October, we have just arrived at the next gold price inflection point, which will further serve to overwhelm mispriced Western gold and silver fix reference points. So really, to sum it up, the 60/40 gold-backed unit is 100% institutional facing. It solves all 3 necessary currency requirements. It is a medium of exchange. It is a unit of account. And it is a non-dollar settlement instrument, which delivers a stable, intrinsically backed currency, providing a better store of value than fiat currencies. And once each currency unit is minted, it doesn't automatically get cashed in. It acts as a store of value. Essentially, it circulates as a gold-backed settlement currency. It's like a foreign exchange cross, essentially, amongst a growing number of BRICS participants who are growing, requiring more physical gold grams and a rising gold price. At every integration, you're going to require more gold to be vended into this situation. And when you think about it, this is much bigger than anyone imagines. As BRICS plus trade strengthens, it stabilizes gold prices higher and higher based upon real supply-demand fundamentals. More importantly, it provides a growing number of BRICS Plus members access to an entire non-Western facing sanction-proof banking suite based on high-quality liquid asset gold and all the benefits that a high-quality liquid asset can provide. And we delved into the significance of this in the last few episodes. Glasnev's gold currency is officially born, backwashing into the Western-facing gold corridor, where global-facing producers, refiners, institutional investors, and the like can utilize limitless, debt-free liquidity in a stable supply-demand environment. The increasingly illiquid debt-based LBMA CME cartel is dead in the water, likely why JP Morgan is moving its gold trading hubs to Singapore. Just one more reason. In fact, JP Morgan admitted that the unit is, quote, perhaps the most thoroughly fleshed out of the de-dollarization proposals that exist I'm just reading it here, that exist in the cross-border transaction space for BRICS plus, end of quote. What we're witnessing in real time is that gold as money has just arrived at the next in a series of unprecedented bullish inflection points, which far exceeds the price effect the launch of the physically backed Shanghai Futures Exchange had, which net of pullbacks, even where we are today, and net of these pullbacks is still over $2,200 price rise in dollar weighted against dollars, that is, in this 19 months since then. Now, the Enbridge unit effect will be exponentially larger, capturing the multi-trillion-dollar global South trade. Now, based on the quantity of physical gold actually required to back these initial 5 BRICS plus currencies, in aggregate, based just on the trade currency in play, our liquidity providers suggest it's going to require $5,000 gold in the very short order, in very short term. And that jives with most bullion banks' existing estimations. However, based on what we're hearing, the next integration phase commences in January, and it's going to require an $8,000 gold price to actually support these growing banking relationships.
Hey, Andrew, we've had a lot of questions in the last 2 weeks on what you're seeing in silver, both in the short term and also in the long term moving forward here.
Yeah, this is so interesting. Let's start with Beijing's deliberate hurt and rescue operation. This is a classic hurt and rescue operation to take control. It best explains the real reason for the CME 10-hour market halt, which came very, very close to triggering an LBMA CME force majeure event. Unthinkable. Now, there's been a lot of speculation as to what the real reason was for the market halt. It's varied from a hack to insiders buying time to bail out large end-of-year December contract derivative bets, which had basically to be marked to market at first notice. So let me just expand this out a little bit so we can better look at it. This is where first notice came in. Now, bearing in mind that was a day early because essentially first notice had been cleared the day before. This was really the day after the Thanksgiving holiday. This was Black Friday. Really gave away, and this is where the market halt was, what really gave away this was an officially orchestrated market halt bailout was that both gold and specifically silver had spiked higher into the very large SGE and SGEI demand at the exact moment that the CME went down. So literally 2 hours after the Black Friday opening here. So you have to ignore this fix because we had to place it where it should be, but this was right inside a 10-hour halt, which really the CME halt was only relieved at the pit open. So essentially 2.5 hours in, and that's what it was, the liquidity providers announced or reported as the sudden appearance of massive SGE physical buy orders, which was so large it forced automated LBMA COMEX short covering, spiking up the silver bid stack, forcing short-sold margin calls into a bid-only condition. It was this condition that triggered an automated CME 10% circuit breaker market halt. Also, it's hard to identify the buyer. Someone simultaneously placed a fully paid-up order for 1,140 tons, and this was placed right at the beginning, 1,140 tons of December silver into first notice. So this SGE order came on top of that. Now, bearing in mind that over a third, and this was into first notice. Now, bearing in mind that over a third of all registered inventory was being sought for backdoor delivery, and which, given this exceeds the single position limit cap of 933 tons versus the 1140 that they were demanding, looked suspiciously coordinated. Someone wanted otherwise impossible to obtain physical silver in a hurry. And as we previously identified, circuit breakers only kick in to protect the house. And historically, they're always to protect the shorts when called upon to deliver. Every time over the last many years, that is the one consistent time where we've had market halts. And we've looked at these circuit breakers in detail in past episodes, which is basically revolves around while the CME house pit managers who have a footprint in both the CME and the global FX spot markets, while they can continue to position themselves in the foreign exchange markets when the COMEX is halted, captive CME longs and shorts are frozen for a minimum of 5 minutes in the futures and a minimum of 3 minutes in the options market. While insiders, they can continue to operate in the FX markets. That is one of the things that happened in the CME halt. However, as a direct result of the SGE now price settling global silver price outside of the LBMA exchange, on this occasion, LBMA spot silver continued to trade flat during the 10-hour CME halt, while the December shorts, who had foolishly chosen to roll their short bets into the new front-month March contract, which this chart is reflecting, they were frozen, literally frozen into the spot exchange for physical premium expanding, which has expanded to as high as $7,000 per contract. That was going to rinse people out. It was these non-house held positions that were margin called right at this CME margin halt. Now you can see here, and if I expand this out just a tiny bit more, just to bring it to that level, you can see this spike here was exactly where all of this concatenated and the halt was called. Now the halt was actually called at 54.65. That was futures 54.65, when the as yet unfilled bid stack gapped all the way up to over $60, like from here to here. And essentially, that was $27,000 per contract higher than people who'd rolled or taken a position in this March contract right here when it was called. Now, really important to just look at this in context. The circuit breaker halt actually should have been relieved by a subsequent automated CME silver market open. It should have happened 5 minutes later. Didn't. However, the paper to physical bid stack spread was so wide that this is where the COMEX gearbox blew up, and blew up permanently. So Black Friday 2025 is going to be looked back at as the inflection moment that the 50-year Western silver price suppression game finally blew up, exposing the fact that into a supply shortfall, no amount of freshly printed repo dollars could have bought back enough physical silver to fill a $4 billion SLV OCC black hole. The SLV short positions are hedged in an unallocated silver position, which is in the listed in the Office of the Comptroller report. Neither are real. Now, the 24.4 billion borrowed by the banks ahead of the CME reopen in the repo event was undoubtedly a short-term bailout until a deal could be done to appease, really, Chinese lessors looking to reclaim their bullion, compounded by the fact that SGE leased silver was being called back into restock depleted 15-year Chinese warehouse shortages. They want this back as we move into 2026. And without a circuit breaker halt, the 4 billion CME SLV liability was assessed as expanding probably to as high as 10 billion, which would have been enough to bring the entire interconnected 2 quadrillion derivative banking system down. So that wasn't going to be allowed to happen. What didn't suit anyone for that to happen? And with the LBMA float already decimated and so little CME open interest left for the chips, basically, in the casino, left for the cartel to short cover into, China sent a message that they have taken the silver gloves off. And following export controls and rumors of fresh silver tariff mandates being implemented, and that could be likely over a weekend that we could get a call like that, the PBOC is now aggressively calling in their long COMEX spot and very large SLV longs for physical delivery. This precedes a full lockdown of Chinese silver export that kicks in January. BRICS countries buying or selling silver in the future are going to be strictly licensed inside this SGE corridor. Now, we've previously identified as an as yet unknown but very large percentage of the 4 billion of short sold SLV positions are held long by the state-held Chinese banks, who are calling their leases back. Beijing has been biding its time to pull the trigger on silver and knows the Fed's untenable OCC short silver position, being stick-handled by the LPMCL, is the West's Achilles heel. Now, clearly, this is a fine balancing act, and the last thing Beijing wants is to shoot themselves in the foot by imploding the entire 2 quadrillion derivatives complex before they can retrieve their leased metal. And to avert an unthinkable COMEX default, and to buy enough time for the Fed officials to look for short sold paper, to get hold of short sold paper silver, to get rid of it, a deal with state-owned SGE PBOC officials, it had to be struck. There's no doubt a deal got struck, namely to allow Western officials time to pay the backwardation surcharge while this metal gets returned. We're witnessing that as we speak. And as we've recently asserted, Beijing has gained sufficient physical market liquidity to take full pricing control of all global gold, silver, and rare earths and listed critical minerals, and have now really taken the gloves off, moving from stealth to openly draining as much underpriced supply out of Western paper exchanges as they can without upsetting the apple cart. Chinese buyers have quietly been capitalized on the COMEX monthly mark-to-market wash and rinse cycles, so obvious. Once more, by spot indexing that's locking in mispriced silver in the FX markets, alongside loading up record volumes of December silver futures longs, these chips, but in this case, to take delivery. And all of this has happened into synthetically capped prices. And specifically, the synthetically capped first notice mark-to-market event. China standing for delivery of registered COMEX open interest is what broke the shorts back. However, with silver having broken out amongst above this very long term, I mean, we're talking a 15-year cap, when it broke out above that and couldn't get pushed back down due to things like export control, unfactored things like export controls and SGE stocks at 15-year lows, the moment first notice bets had been synthetically squared, the race to pull the trigger to stand for physical delivery began, and it took just 2.5 hours of Friday morning trade before the COMEX was overwhelmed with bids they were unable to fill. So to kind of sum it up, the official margin call in silver was so large that all trades had to be halted to hide a CME LBMA force majeure event. And what we are certain of is that every single global-facing bullion bank is long physical and ETF gold and silver for their own house and client accounts. Now, for their own books, the historically accrued short bets against silver and gold are directly linked to officially held OCC bets. That is the Fed's position. No bullion bank is on the hook for those. And essentially, although it's been stick-handled by them, they're not on the hook. These bets are squared always on the last day of each month, the exact day the CME went into default. Now, ever since the moment Beijing took its gold gloves off, launching the physically backed Shanghai Futures Exchange gold contract on the 1st of March 2024, which overnight usurped the gold price setting mantle from the West, has resulted in a persistent series of sequentially higher, physically determined monthly gold prices. Into attempts to manage massively leveraged offside derivative bets, the Fed has been forced to borrow physical gold from the BIS, leverage it, and then being forced to sell it into the market at a loss. This is what's been forcing offside Fed-centric gold to be paid back and marked to market at relentlessly higher prices. We've tracked it month after month. Beijing has been playing the long game and into the process has taken full control of the global gold and silver price setting mechanism. However, into the current massive silver supply versus demand shortfalls, compounded by export controls, what we've just witnessed was Beijing really, we've seen them take the gold gloves off, they took the silver gloves off. And the effect, though, with silver, for good reason, is exponentially more dramatic, because unlike gold, where you can print enough fiat to buy back short bets and drive a higher price, incentivizing some offers to come to the market to enable officials to cover unhedged short positions, albeit at higher prices, there is simply insufficient silver bullion available to buy back to short cover, to pay $4 billion of massively shorted, unallocated FX silver positions. So, Shane, to answer the very short-term questions that we got, and we're recording this episode ahead of FOMC this evening, and we expect the usual, as we're seeing here, insider stop hunting to kick in at the announcement. However, liquidity providers report opportunistic dip buyers are underlying, and once specs have been tricked out or tricked in short, one or the other, insiders exposed to large SGE demand will short cover. As a reminder, we're recording this ahead of FOMC. You'll have that data, and it's going to be, we expect an enormous amount of chart chop between there and then. But once Friday comes and this Wednesday volatility finally settles down, really nothing's changed in the big picture. So again, if you're a futures trader and you have stops in the market, they will be hunted out. They are visible to the insiders. And that's what this is all about. There's always inverse spikes up and down to hunt for static stops. Obviously, the commercials use algorithms that will hunt out what generally speculators would have a stop place at a specific level. You only need a few of those aggregated and they will get hunted out. So anyway, I just want to bring that in mind. So, but clearly the bigger picture for gold and silver is extremely bullish. However, to address very short-term subscriber questions, as we witnessed directly after the pit close on Friday here, and once again on Monday, as soon as London cleared for the day at 4 p.m., and the subsequent capping that we have seen into FOMC later today, insiders moved to pull bids in both gold and silver futures to try and short cover into low-hanging spec longs, as I say, hunting out static stops all around the 10-day moving average. This just happens to be the 10-day moving average today, which is 43.2150. It's spot adjusted. And essentially, it's just literally this synthetic action is happening around that 10-day moving average. That's all that's happening here. This is the round number. This is where 4200 spot is, which is 42.2760 today in futures. And there's clear capping going on. So just to put that into perspective, and par for the course, we expect all the obligatory chop into FOMC today, and it's no surprise to evidence this synthetic capping at this moving average that we just discussed. Spot gold looks ready to catch up with the silver rally, and all dips below the gold futures level of 4,200 have been front run after the Friday initial just test of that. Big buyers came in, and what it's telling us is there's a lot of institutional buyers at that level. Clearly no such luck in capping silver futures. The silver fix yesterday and again today, literally here and here, where obviously, I mean, it is laughable, really. It evidenced a very large buyer taking absolutely everything on offer, further tightening supply into an ongoing short squeeze into all-time high fixes, spooking shorts to buy back SLV shorts. Now, with the sharks circling around depleted COMEX inventories, the moment London had settled, the PM gold fix, the short squeeze accelerated, the pit closing into the daily highs, closing at, this is where the pit closed, yesterday's all-time highs. And again, that spooked more shorts into the current 62.14 rally, which is just this morning's high of the day, before there was obviously this little bit of chop going on ahead of FOMC. This is where the 80 level is. This is the current channel, having broken out of the prior channel. This is the current channel. Now, it looks very aggressive. Yes, there will be some open interest, some spec open interest here, which can be rinsed out. And that's very healthy. And that's what we're seeing a little bit now. But it really looks like it wants to take out the 63 level pretty quickly. It looks magnetic. The current ratio trade has gapped lower into the mid-68s. Well, it's 69 now. It was 68 just a short while ago. A little bit of gaming going on here. But essentially, it is more immediately looking to test the July 2021 66-1 low. And then, of course, we do expect we can move down ultimately for a test of the 30s, one step at a time. And the rotation out of GC into SI has assisted the commercials to synthetically weigh on gold futures, which is what we're seeing here. However, as I say, providers report very strong institutional gold demand is underpinning synthetic efforts to cap gold. All of these rinses are extremely constructive, flushing out spec longs while securing the next rising physical support step to rally from in both gold and silver. And gold rising in a very orderly channel, as I say, with these higher physical support steps evident.
Now, with the Fed on the back foot into rising prices and increasingly forced to turn to the repo market to manage underwater positions, it's no surprise to evidence some official pushback attempts. Let's dig into them. It's interesting to note that while the Bank of International Settlements is long gold its trading desk and has been clearly tasked to step in to try and talk gold down, blaming the gold price rally on retail investors. However, looking at the data, with open interest close to half of the 2020 800,000 level and 17,400 contracts below the 2025 highs, this is clearly not the case. Far, far from it. Now, we've been drawing attention to the freshly activated institutional 40-20-20 allocations to gold, which also involve funds who are not actually mandated to hold physical. So to gain the necessary percentage of gold exposure, they're forced to buy gold ETFs, GLD ETF shares, and also they can invest in COMEX open interest. The problem with the BIS spin, and that's drawn attention to in this Financial Times analysis, is gold ETF demand is very, very sticky, and it's not speculative, and it is not rinsable. There are two things to note. We know the Bank of International Settlements is long on behalf of all the Western-facing central banks that it manages gold for, and our liquidity providers are certain. The BIS Gold Trading Desk manager Benoit Gilson, who we've referred to many, many times, he stopped selling or leasing out central bank sight gold in November 2022 when the BIS covered all of the remaining 500 tons of its leases. In fact, into this September to October physically derived higher stairstep, 15 tons of Fed-held Bank of International Settlement gold swap were repaid at a $212 higher price. It's logged. It's actually visible. Now, the Fed is feeling the heat, and it is really clearly asking for help in trying to cap the relentless rise in the gold price. However, with the price being set in the SGE physical exchanges, the BIS is pretty pushing on a string trying to talk gold down. I mean, that's all they've got is talk. And while this has spooked the dwindling rinsable volumes of the spec futures gold open interest, this spec held stuff, there's just simply insufficient COMEX open interest warrants floating around to gain significant downside traction. Also, for reference, spec open interest in silver futures is also muted. Bearing in mind, silver futures are in the crosshairs for backdoor deliveries of underpriced bullions, with commercials caught short last week. Very little of the spec held open interest is vulnerable. Obviously, there is some. And as we've seen in the charts, expect some of that to get rinsed. Highly constructive. So as we wind down for Christmas and embrace very bullish expectations of an exponentially more bullish 2026, the only question that remains is actually the same one we started with in January and have repeated in some version or another all the way through the 2025. And in fact, we started with gold at 2,500, silver below $30. The only question is now, how much physical gold and silver do you own as we are about to launch into 2026?
All right, that wraps up another episode of Live from the Vault, brought to you by Kinesis Money, and a big thank you to Andrew Maguire for sharing his deep market knowledge, as you can see, and also to you for tuning in here and being a part of this growing global community. And if you're new here, make sure that you hit that subscribe button right there. Give us a like. Don't forget to give us a like, and also hit the bell if you want to be the first to know as soon as we go live. And if you've been with us a while, and many of you have been with us a long time, help keep spreading the word about this channel by giving us a like right now. Share this episode with someone that you know needs to hear this information, and get your questions into Andrew Maguire. And you never know, your question may well be selected for the next episode of Live from the Vault. And with that, we'll be back next time with more truth that you just won't find on the mainstream media. And until then, remember, like Andrew says, buy physical, make sure it's backed. 1-to-1. And we'll see you right here next time on Live from the Vault. Bye for now.